colleague and friend, Mark Parker from BIP Wealth. Thank you for doing this with me, Mark. I appreciate you.
Glad to do it. Thanks for having me.
Tell me, just to start off with, what is the difference between a wealth advisor, which is what you are, and an investment manager? I hear those terms thrown around a lot, and I think, everybody doesn't always know the difference between those two titles.
Sure, and I'll actually throw in a third one, and that's a financial planner.
Do it.
A lot of times those three get interchanged, but there are nuances and they are different. An investment manager is really just what the name says. They manage investments, and a financial planner does financial planning. Both of those are part of what a wealth manager does, but a wealth manager is really more of a comprehensive role that involves investment management. It involves financial planning, as well as really being kind of a personal CFO to be able to speak into any financial decisions within their client's life, which that's a lot more than a typical investment manager or just a financial planner.
I love that idea of a personal CFO. I'll take it. I'll take one. I know you keep trying to get me, but honor your father, right? My father's my wealth advisor. Okay, so here's something that I see a lot of times with business owners. There's this, they've got this great team in their business. They've got a CFO, a business CFO, not necessarily a personal CFO. They've got an accountant, but they try very hard to keep their business finances and their personal finances separate. And that seems, I don't know if it's a myth, or I don't know what you would call it, that there really is such a thing for a small or mid-sized business owner to really be able to keep their personal wealth separate from their business wealth. Do you have a point of view on that?
Yeah, ultimately, with a closely held company, small business person, personal and the business really, while they're separate, they're really connected. We look at it as kind of three legs to a stool, with the personal finances, the business finances, and the business itself as being three distinct kind of entities within that. But they're all interrelated, and anything that has a substantial impact on one of them is going to affect the other two. So while you try to keep it separated, they are still interrelated.
Can you give an example of how that works, or an example maybe where somebody didn't do that well, and it cost them?
Well, a couple of different scenarios there. One is some will try to commingle, if you will, the personal and the business too much. And so when they go to try to sell the business, they don't really have good records because they're paying their boat payment or their lake house payment out of the business, and that really can cause a problem. The other side of that is thinking that they're completely independent, but then you have some sort of a catastrophe in the business that will end up draining both the business financial side and the personal financial side.
Mm-hmm. So where do you, how do you vet somebody? I've had over the years, so I've had my practice for the most part since 99, even when I wasn't working in it, right? And I have gotten really poor counsel that cost me a lot of money. And I've had advisors look at me and go, "What do you think we should do?" And I look at them and say, "Well, honey, that's why I'm paying you." I'd like you to have a point of view on this, right? So these are the things I'm expert at, and I expect you to kind of be an expert at
Right.
this. So, I mean, I know that over the years I have made some costly mistakes with my advisors. How do you vet these people well? What are some good questions that we should be asking?
It's a great question. There's a couple of basic things, and first of all is understanding how someone is compensated. Because if people don't have the right incentives, no matter how well-meaning they are, we're all still human. So you want to make sure that you're dealing with an advisor who is compensated properly. And when I say that they're aligned with your goals. There's something called a registered investment advisor, which is what we are at VIP. We are a fiduciary. So we are obligated to have the client's best interest in mind. We don't sell products. We don't make commissions or referral fees, anything like that. A lot of players within the financial services arena are incentivized very differently than that. A lot of financial planners and wealth managers are connected to, let's say, a particular insurance company where they are captive to certain products. And I think that's really the first thing I would try to understand is how someone is being compensated. And if they have a full suite of products that they are able to provide for.
Okay. And this is going to sound ridiculous to you, but and I'll just set it up with a story that I had asked my health issues, right? And so I was going to a new doctor at one point, and I said to the nurse, "So tell me about Dr. So-and-so." And she said, "Well, he's so nice, Miss Gentry. He is like, and she described all these things about him. And I said, well, that's a bonus, but is he smart? Because that's what I want. I'm looking for somebody that's smart." And I feel that same way about people giving you financial advice personally and in your business. Like, I'm looking for this, and maybe you can't tell me a thing, Mark, and I know I'm putting you on the spot, but how do I figure out if this person is smart enough to be a part of the team?
Well, I think you can look at credentials. There's the Certified Financial Planning designation, the CFP, which is a pretty rigorous designation to obtain within the industry. And that's kind of I think that's a bar that I would look at as something significant. Also look at the organization and make sure that it's an organization that has a good reputation. There are some online tools to be able to see if there's been complaints filed against an advisor, because we are a regulated industry. So anyone in this industry has a license, and you can do that.
Give us one of those tools. What's one of those tools we could check on?
You can go to the SCC and FINRA have websites that you can check, and you can find out someone's history on there if they've got a checkered past.
So we talk a lot with business owners that are thinking about exit. They're starting to plan for exit. They want to know what they should be doing for exit. And so what does your one of the questions that we ask, and I know you ask, is what does your business need to do for you on exit? And we get, sometimes we get looks like, what's the question? And then the other time, and I think we just talked about this with somebody recently, there's a kind of an expectation around what the business is going to be able to do to set up a particular lifestyle. But tell me, and we use a similar term, right? A lot of owners, they get income from their business. They're not necessarily creating wealth in their business. And that's what makes your business ultimately sellable for a price that enables you to live the kind of lifestyle that most people want to live in their retirement, or to be able to take that money and do something else. So explain the difference for folks from your point of view, not my point of view. What's the difference between creating income in your business and creating wealth in your business?
Great couple of questions. They're all in one. Let me try to take it one at a time. The first is, what does your business need to do for you? And I'll go back to the wealth management discussion. And any wealth manager, the process should always start with a comprehensive financial plan. If someone is giving you investment advice and doing that outside of a plan, then that's not a good idea. You can't make investment decisions in a vacuum. You really need to look at them in the context of the overall financial plan.